Hello and welcome to the capstone video in our discussion of the 4 fundamental financial statements that accountants produce. Now, if you have not done so, I highly encourage you to go back and watch my 4 videos on the income statement, the balance sheet, the retained earnings statement, and the statement of cash flows before proceeding with this video. Because if you do not have a fundamental understanding of all of those individually, when we tie them all together here, it's probably going to be even more confusing. So make sure you have a firm understanding of each financial statement on its own before diving into this integrated financial statement. Now, our example here, we have a doctor. His name is Dr. Landry, and he is setting up his medical practice for the first time. And he is calling it Family Healthcare PC. And PC stands for Professional Corporation, which, depending on where you live, can be set up for professionals like doctors and attorneys and things like that. So that's not really important for the video, but that's what he's calling his business. And what we're going to do in this video is actually keep track in real time all of his transactions for the first month. Now, over on the left-hand side, you will see a list of A, B, C, D, E, F. And those are going to be our 6 transactions for this month, all the way from the initial investment to paying out dividends at the end of the month. Now, the spreadsheet is set up so that each financial statement is tied together by Excel formulas. So when we change things in the balance sheet, some of that is going to cascade down into other financial statements. And the same thing holds true for the other ones. So we have the balance sheet up top, the statement of cash flows in the lower left, and the income statement in the lower right. And our spreadsheet actually has the formulas built in that will change certain things as we go. Now, over on the right-hand side, I have sort of the fundamental accounting equation set up as a check to make sure that we're not making any mistakes. So again, there are formulas in those cells that will make sure our assets always equal our liabilities plus our equity. So we're going to take our time, insert each transaction into our integrated financial statement, talk about what it means and how it applies to what we've learned before, and once we're done, you will see how everything is tied together. Great. So let's go ahead and do our first transaction. Now, to get the business off the ground, Dr. Landry is going to use $6,000 of his own savings to start the business. So he's going to take $6,000 out of his own personal account, which, for our purposes, we're not worried about. Whatever comes out of his personal account, that's a whole different issue. We only care about it when it comes into the business. So Dr. Landry is going to take $6,000 of his own money and put that into the business. So where it says A, we have investment by Dr. Landry. So let's look at our balance sheet first. Now, where do we put it? Well, we're receiving cash. So we are going to receive a cash asset of $6,000. So we'll go ahead and type in $6,000. Now we know that it also has to go on the other side of the balance sheet. So it either has to go in liabilities or it has to go somewhere in stockholder equity. Well, it's not going to go into liabilities because we're not borrowing that money from a bank or anything. It's just Dr. Landry bringing his own money into the business. Now, since he is the sole owner, at least at this point, and it's not going to be retained earnings because he hasn't done anything yet, it's going to be capital stock. So in exchange for his $6,000, he's going to receive $6,000 in capital stock. So we'll put $6,000 over there. Now let's pause here and take a look at the way our formulas have worked here. We have $6,000 in cash assets, and we have $6,000 in capital stock. So our fundamental accounting equation is balanced. And we can check that over on the right because our little set of formulas over there is saying, okay, so 6,000 equals 6,000. Now, if we go down to the statement of cash flows, we will see that we now have an entry under A for financing. Because remember that cash coming into the business, we're using that to finance the setup of our medical practice. So we have a cash inflow of $6,000. So automatically, right away we can see how, in this case, the balance sheet is tied into the statement of cash flows. When we have cash coming into the balance sheet as an asset, we're going to have that cash also represented as a financing activity in the statement of cash flows. Okay. Now, in order to get the business going more, Dr. Landry is going to take out a loan from the bank. And he's going to take out a loan for $10,000. So where do we begin on our balance sheet with that? Well, once we sign the paperwork, the bank is going to deposit $10,000 cash into the business account. So we're going to have cash asset of $10,000. Now we know that has to also go on the right-hand side of our balance sheet, but where is it going to go? Is it stockholder equity? Is it liabilities? What is it? Well, if you remember that when we take out a loan from a bank or another financial institution, we have the obligation to pay that back. So that is a liability. So the $10,000 will go under liabilities on the right-hand side of our balance sheet. All right, so let's look at our check over there on the right-hand side. So 16,000, 16,000. We're green, we're okay over there. Now let's go ahead and look down at our cash flows. And again, the loan from the bank, which is transaction B, is a financing transaction. So in statement of cash flows under B, we have a financing activity, and that is a cash inflow of $10,000. So again, those two are tied together, balance sheet and cash flows. Let's go ahead and talk about our next transaction. Eventually, Dr. Landry wants to build his own building for his medical practice. So he's going to buy a parcel of land, and that's going to cost $12,000. So how is this going to work? Now, he's going to have to pay $12,000 in cash, but he will receive $12,000 worth of land. So how are we going to do this on our balance sheet? Because cash and land are on the same side. They're on the asset side. Well, that's no problem. Because as long as we do the same transaction on the same side and they balance out, that's fine. Or they can balance out on both sides of the accounting equation. It doesn't make a difference. So we're going to spend $12,000 of cash to gain $12,000 of land. Now let's take a look here. All we really did in this transaction was transfer one asset into another. We turned cash into land. And if you notice on the right-hand side, it did not affect our accounting equation at all. We're still at 16,000 and 16,000 because the transfer of one asset to another is basically neutral. Now, I do want to point one thing out. If we go down to the bottom of the asset column, you will notice that our cash is now 4,000. We used to have 16,000, but now we're down to 4,000 because we used 12,000 of that to buy land. But we accompany that $4,000 with the new $12,000 in land. So our assets are still $16,000. Now, if we look down at the statement of cash flows for transaction C, that is an investing activity. So the purchase of the land using cash is an investing use of that cash. And of course, the bottom of our cash column in assets is $4,000. And if we look at the bottom of our statement of cash flows, that's also $4,000. All right, so let's go down to transaction D. And that is fees earned. So during this first month, Dr. Landry earned fees for his medical business of $5,500. Now again, we know that that has to go on the right-hand side of the equation somewhere. Is it a liability? No. Is it capital stock? Is that new money coming into the business? No. That's his patient's money that they're paying him for his medical services. Well, those are earnings. as of right now, they are retained earnings. So $5,500 in cash balanced out by $5,500 in retained earnings. So if we look at our accounting equation on the right-hand side, we have 21,500 equals 21,500, and we're okay. Now if we go to the bottom of our asset column, we will see that we now have $9,500 in cash and our $12,000 in land. Now if we go down to our statement of cash flows, we can see that transaction D is an operating cash flow. So the fee income takes place through our operations, and therefore the cash that comes in is operating cash flow, positive operating cash flow. Now on the right-hand side under stockholders' equity, you will see that we still have our $6,000 in capital stock. We have our $5,500 we retained of our earnings in transaction D, and we still have our $10,000 liability to the bank. So everything balances out, $21,500 and $21,500. Okay, so now we are to our paid expenses. Now, of course, running a business requires, the payment of certain types of expenses like wages and utilities and stuff like that. So now we're going to go down to the income statement. If you notice there, we have fee income, which is the same thing as fees earned up in the balance sheet of $5,500. It's the same thing as operating cash flows in transaction D in the statement of cash flows. That's also present under fees earned. So that transaction appears in all three. And again, that's what we mean by integrated financial statement. Now, as far as our paid expenses, we're going to go ahead and enter those into our income statement because that is an operating expense, right? So during this first month, Dr. Landry paid $1,125 in wages. So $1,125 in wages. He paid $950 in rent. So $950. He paid $450 in utilities. So minus $450. Now at the end of the month, he has to pay $100 of interest on his $10,000 loan. So that is $100. And then there are miscellaneous expenses that came out to $275. Okay. Now if we look up at our accounting equation on the right-hand side, it says error. It's not balanced yet. So we have to go up to our balance sheet, and where it says paid expenses, there we have the total of $2,900 in paid expenses. And that is simply the sum of the wages, rent, utilities, interest, and miscellaneous down in the income statement. So there's a function or a formula that adds those up and puts it in paid expenses under cash assets. And again, that is an outlay or a payment of cash. Now, of course, that has to have some partner over on the right-hand side in our balance sheet. That's why we're getting an error in our accounting equation on the right. So, is that a liability? It doesn't have anything to do with a loan or anything like that. Is it capital stock? Definitely not. So, where is this going to come out of? Well, we're going to pay our expenses out of our retained earnings. Okay? So whatever the earnings we keep in the business from our fees, we're going to pay our expenses out of that, and that should make sort of intuitive sense. So we're going to balance out the $2,900 under cash assets with minus $2,900 under retained earnings. There we go. And our accounting equation on the right likes that, so we're all green again. So we're okay. Everything is balancing out. Now I do want to point out that down in the statement of cash flows, if you see under transaction E, we have another operating cash outflow. And that is the $2,900 we just paid to cover our expenses. So that $2,900 in the balance sheet up at the top and minus $2,900 in the statement of cash flows comes from our expenses in the income statement over at the bottom right. Okay, So we really have one more transaction, and I think we're just about done. Now, at the end of the month, Dr. Landry decides to pay himself, because he's the owner, pay himself a dividend, which is a cash payment to the owners of the business. And in this case, he's the only one. So he's going to make a cash payment of $1,500 to himself. So we're going to have a paid dividend over here of minus $1,500. Now, on the right-hand side, where is that going to go? Is it coming out of capital stock? Well, is he taking away some sort of stock in the business? No, not at all. Where is it going to come out of? Well, it's going to come out of retained earnings. Because remember, a dividend is just a cash payment of part of a company's earnings to its investors. And Dr. Landry is the only investor. So we are paying out a dividend of $1,500 from our retained earnings. So negative $1,500 there. And again, if we look down at the statement of cash flows, under transaction F, you will see a financing transaction. So the payment of dividends is a financing transaction in the statement of cash flows. All right, so let's go ahead and just step back and take a look at this whole thing, because really we're done, and the only thing we have to do is to sort of summarize and review. So let's take a look at the balances at the end of the month. What does Dr. Landry have in terms of his balance sheet? Well, he has cash of $5,100, and that's in two places. You'll see that it's at the bottom of the asset column. We have cash of $5,100, but it's also at the bottom of the statement of cash flows, $5,100. And that's one of the checks that's built into the integrated financial statement. The cash asset at the end of that month should be the same as the net cash available at the bottom of the statement of cash flows. Those should be the same. Now, he also has $12,000 in land, and that is the land he purchased up in transaction C. So on the asset side, we have $17,100. Now let's go to the liabilities and equity side. Well, he still has the $10,000 loan that he owes the bank. That's a liability. He still has his $6,000 he invested in the business. That hasn't gone anywhere. And then at the end, he still has $1,100 in retained earnings. So he earned fees from doing his practice, and he paid some expenses, and he paid himself a dividend, and at the end, he still has $1,100 in retained earnings. So the right-hand side of the equation is $17,100. Now, if we go into the statement of cash flows, we will see that all of our transactions above that involved cash are also recorded in the statement of cash flows. And, most importantly, they're labeled by the type of activity they involved. So we have financing cash flows, we have investing cash flows, and we have operating cash flows. And again, at the end, when we subtract and add all that, our net cash should be the same as our cash above and our assets. Now, in the income statement, we're starting out with the fees that Dr. Landry earned, which was $5,500. And then the cost of generating those fees involved people's wages. So maybe a receptionist at the office or some sort of medical assistant. That added up to $1,125. He had to pay the rent where he's doing his practice, which was $950. Utilities, interest on that loan, and some miscellaneous expenses like postage and office supplies and paper and stuff like that. So in the end, the net income was $2,600. So again, I want to reiterate that the cash flows and net income, and those are all separate ideas. Those are separate. If you look at the net income of $2,600, well, that's well below the net cash at the bottom of the cash flow statement of $5,100. See, they're completely different things. Now the question is, was Dr. Landry profitable during this month? Well, by our accounting definitions, yes, because over on the income statement, his expenses were less than his fee income of $5,500. So his net income was $2,600. So we can say the profit for this month was $2,600. Now, if we go up to our balance sheet and our cash flow statement. Was Dr. Landry ever in a cash crisis? Did he ever face cash insolvency? Was there ever not enough cash on hand? Well, no, there really wasn't. He had a $6,000 cash inflow, a $10,000 cash inflow. Then he bought a big piece of land, but that still left him with $4,000. Then he piled on his fees of $5,500. So he was just fine in terms of his cash flow. And of course, we're assuming these occurred in this order. And cash flows are funny like that. It depends on what order the transactions go in. So if you have a bunch of cash outlays due at the beginning, but no cash coming in, then you can have a problem. But in this case, he did not have any cash problem. And of course, his balance sheet is fine and solvent. He still has $17,100 in assets and $17,100 in liabilities and equity. So that balances out. So really, that's the end of this video. I just wanted you to see how inserting transactions into the integrated financial statement affects other things within it, because it's all tied together. And really, as we go into more advanced topics in accounting, it's all going to come back to this. So think of all the multi-billion-dollar corporations that release their integrated financial statements every quarter and every year. I mean, that's what counts. That's what everyone looks at. So even in a small business like this, which is really helpful to a small business owner, these things translate into huge companies like Coca-Cola and Procter & Gamble and so forth. It really comes down to this. All right, so that's going to cover it for this video. Again, I hope you've learned a lot in this series, and I look forward to seeing you again in our next series where we tackle the next topics in accounting. Thank you very much, and I look forward to seeing you again next time.